Hello friends, DK this side. When we intend to invest in the stock market and design a stock portfolio with the sole aim of getting good returns in future, what is the biggest challenge? The biggest challenge is the selection of the right stocks in the stock. Now, in fact, I would say it is not the selection of the stock. It is the selection of the right business. Stocks are simply means to invest in the right business, which are fundamentally sound business. In order to assess the fundamentally sound business, what we do? We check the past performance of the business. We check the financial health of the business. But most importantly, we check the valuation of the stock at the current market. Because we intend to buy the stock at the value area, so that the possibility of getting a return on that stock or on our investment becomes that much higher. So we do the valuation analysis of that particular business. In order to do the valuation analysis, we use several financial ratios like price to earning ratio, price to book ratio, and price to sales ratio. So in this video, we will learn all about price to sales ratio, which is a valuation matrix to assess the valuation of a stock. So friends, give a lot of thumbs up to this video. Don't forget to subscribe the channel, hit the notification bell for updates. Let's begin our discussion on price to sales ratio, which is known as PS ratio. Let us begin with the definition of price to sales ratio. What is price to sales ratio? Price to sales ratio, which is known as PS ratio, is a valuation ratio that compares a company's stock price to its revenues, that revenues which has been generated to the sales of the product of the company. It is an indicator of the value that financial markets have placed on each rupee or each dollar of the company's sales or revenues. Since price to sales ratio is a simple comparison between the current market price of the stock with the sales of the company, then how to calculate it? The calculation is very simple. In order to arrive at the PS ratio, first we calculate the market capitalization of that particular business. And how market capitalization is calculated? Total number of outstanding shares multiplied by the current market price of the stock will give you the market capitalization of that business at the current market price of the stock. And then we check the sales revenue in past 12 months. Once we know these two data, we can divide the market capitalization with the sales revenue of past 12 months will give us the price to sales ratio or PS ratio of that business. Let us now understand the calculation of price to sales ratio with a simple example. For example, if a company has a market capitalization of 20 billions and the sales of the company of past 12 months stands at 10 billion. So the PS ratio would be 20 divided by 10, which means the price to sales ratio arrives at 2. What does it mean? It means that the investors or the market is willing to pay $2 for every $1 of the sales that the company is generating. Now we have learned how to calculate the price to sales ratio. But the question arises as to how we can make interpretation of price to sales value to understand the valuation of a particular stock. In general, a lower PS ratio is considered to be more favorable because it indicates that we are paying less for each dollar of the sales. However, the PS ratio should be interpreted in conjunction with other valuation metrics like price to earning ratio, price to book ratio. The best way to understand the price to sales ratio is to make a comparison of the companies or the businesses within the same industry to have a better understanding of price to sales ratio. Now let us understand what are those factors which can affect the price to sales ratio of a company. Number one is the company's growth rate. Number two is the company's profitability. Number three is the company's industry in which the company is doing the business. And last is the general market conditions. Let us understand one by one. Just imagine if the company's growth rate is very high, because the investors are ready to pay higher price for each dollar of sales of that company in anticipation of the higher earning growth. Number two, if the company's profitability is higher, then PS ratio could be lower because the investors are quite confident about the company's ability to generate good profits. Then the industry. The company's industry in which the company is doing the business is very important, because the PS ratio can vary from industries to industry. So we cannot make a comparison of the PS ratio from a company of a IT sector to a company in FMCG sector. If the market is quite bullish or very in a strong uptrend, the general sentiments in the market is very good. Investors are quite optimistic. In that scenario, the PS ratio could be higher. And therefore, it is very important to always study the PS ratio with respect to the company's growth rate, company's profitability, and industry of the company in which the company is doing the business, and the general market conditions. And it is always better to do the peer group analysis. It is better to make a comparison of a company's PS ratio with the similar kind of companies doing the business in the same kind of sector or industry. Now let us take an example as to how PS ratio should be understood. For example, we are doing an analysis of the Microsoft stock. Now, Microsoft is the technology company. So we have to make a comparison with the other technology companies. So here we can make a comparison of the PS ratio of Microsoft with Oracle, Meta Platforms, Apple, or Alphabet. If we see the PS ratio of Microsoft, it stands at 11.3 times, while the Oracle is 6.3, Meta Platform is 6.1, Apple is 7.2, 5.6 is Alphabet. So, considering the only aspect of price to sales ratio, Microsoft is looking little expensive because the peer group average of PS ratio stands at 6.3, while Microsoft has 11.3. So, it is looking expensive. However, this is not the only criteria in which we can assess the valuation of a stock. We have to look at the PE ratio. We have to look at the PB ratio. We have to look at the fair price value or intrinsic value of the stock. So other fundamental parameters or financial ratios should be kept in mind while overall assessing the valuation of a stock. Now we have done the peer group analysis to understand the price to sales ratio of Microsoft in terms of valuation. Now let us make a comparison with the industry, technology space as a whole in the US stock market. Now Microsoft has a PS ratio which is 11.3, which we have discussed just now, while the industry average overall is 4.5. So as far as price to sales ratio goes, Microsoft is looking expensive in terms of price to sales ratio. We can finally conclude that overall PS ratio is a useful tool for fundamental analysis, especially to understand the valuation of a stock at the current market price. But it should be used in conjunction with other valuation metrics to get the complete picture of the company's valuation before we take a decision to invest in a particular stock. Friends, give a lot of thumbs up to this video, share this video, subscribe the channel, hit the notification bell for updates. Looking forward to meet you very, very soon.